You ever see a stock with a crazy high dividend, like 10%, and you think, is this the deal of a lifetime, or am I about to get totally burned? Well, today, we are diving headfirst into that exact question. We're going to look at the thermal coal industry to figure out what Wall Street calls a value trap. And you'll see how this huge structural shift in the market is changing all the rules for investors.
So let's kick things off with a healthy dose of skepticism, shall we? This comes from the legendary investor Charlie Munger. His whole point is that commodity businesses, like mining, they're super tricky. Their entire future depends on global prices they have zero control over, and they're often built on promises that are, let's say, hard to nail down. This really sets the perfect tone for us. We've got to look past the shiny, attractive numbers on the surface.
And right here, this is the core of it. This is the dilemma. So you see a stock, maybe it's a coal company, and the market clearly hates it. All the headlines are negative, the long-term story looks grim, but man, it's paying out this massive 10, maybe even 12% dividend. So are you being a genius contrarian, buying up what everyone else is too scared to touch? Or are you just walking straight into a trap? Now, to be fair, the argument for buying is really compelling. The entire idea of value investing is to find stuff that's mispriced because everyone's way too pessimistic. You're supposed to look for companies that have some kind of problem that scares off the herd. When the market thinks a company's future is toast, its price can fall way below what it's actually worth today. That, right there, is the contrarian's dream. Okay, let's just stare at that big, beautiful number for a second, a 10% dividend. The logic is so seductive. Imagine this. You buy the stock and then, bam, the market crashes 50%. It feels awful, right? But then you remember you are still getting paid. In 1 year, you get 10% of what you originally put in back in your pocket, in cash. And you can take that cash and reinvest it when everything's on sale. That dividend acts like this amazing cushion, turning a scary moment into a huge opportunity. You can see why it's so tempting. But here comes the twist. While all that contrarian math seems totally solid on paper, there's this invisible force at play. It's a massive, structural change that is fundamentally rewriting the rules of the game for industries like this. It's like an invisible wall is going up, and it's stopping buyers dead in their tracks no matter how cheap these stocks look. And that invisible wall, it's called ESG investing. For generations, financial models only cared about one thing: profits. But a massive generational shift is happening. Today, big institutions, the ones with all the money, are increasingly required to think about environmental, social, and governance factors. They want to align their capital with their values. And this isn't some small trend, folks. This is a fundamental rewriting of how money moves around the entire planet.
Now, ESG isn't just one thing. Think of it in two broad flavors. Positive screening is proactive. It's about actively looking for and investing in companies doing good stuff, like developing renewables. But for our story today, the really crucial strategy is negative screening. This is the process of just removing entire categories of stocks from your shopping list based on what they do. And thermal coal, right alongside tobacco and firearms, is almost always at the top of that list to get the boot.
One of our sources had this brilliant analogy. Imagine the entire stock market as one giant block of marble. A simple index fund, it just buys the whole block. But an ESG investor is more like a sculptor. They come in and they systematically chip away the parts they don't like. Poof, there goes tobacco. Gone, firearms. Chiseled away, thermal coal. They are permanently actively removing these sectors from their universe of things they can possibly invest in. And the scale here is just mind-boggling. We're not talking about a few people making a choice. We're talking about trillions of dollars. Trillions. In pension funds, university endowments, sovereign wealth funds, and they now operate under these strict ESG mandates. For them, owning a thermal coal company isn't just a bad idea. It's not an option. It is an institutional no-go zone. Their computer systems will literally not let them buy it. This creates this constant selling pressure that has nothing to do with profits and, most importantly, it permanently shrinks the pool of people who could buy the stock from you in the future.
Okay, so a massive chunk of the market simply will not or cannot buy these stocks. That's a huge demand problem right there. But the issue actually goes even deeper. This invisible wall of ESG sentiment doesn't just scare away buyers. It gets inside and completely breaks the fundamental math that Wall Street uses to figure out what a company is even worth in the first place.
All right, meet the workhorse of Wall Street valuation, the discounted cash flow, or DCF model. Think of it like this. Let's say you were going to buy a local coffee shop. Its value isn't just the cash in the register today, right? No, its real value is all the profit you expect it to make for the rest of its entire existence. A DCF model just does that same thing for huge public companies. It tries to add up all the cash a company will ever generate to figure out what it's worth today.
But you can't forecast profits out to infinity, right? That's impossible. So after maybe 10 years, analysts use this shortcut called terminal value. It's one single number that's supposed to represent the value of all of the company's cash flows from year 11 into forever. And here's the absolutely critical part. This one little assumption about the distant future often makes up more than half of a company's entire calculated value today. It's the most important number in the whole spreadsheet.
And this is where that ESG story slams head-on into the valuation math. One of our sources points out that because of this powerful environmental megatrend, a lot of investors, the very people building these models, see these companies as, and this is a quote, doomed in the long run. And that belief doesn't just affect how they feel, it directly infects the most important input in their entire calculation. This comparison just lays the problem bare. For a normal, healthy company, say a big tech company, the terminal value assumes it will grow slowly but surely forever, right along with the global economy. But for a thermal coal company, well, if you believe it's doomed, you can't assume it grows forever. You have to assume it shrinks, and maybe it shrinks all the way to zero. And when you plug a zero into that super important terminal value calculation, the entire perceived value of the company just collapses.
So let's put it all together. You've got a shrinking pool of potential buyers on one side, and you've got a valuation model that's fundamentally broken on the other. All of this leads us to the brutal truth of the situation, the core idea of this whole explainer, the value trap.
This definition from our source material just nails it. It's not just a company that looks cheap, it's a company whose cheapness is actually justified because its core business is evaporating. The trajectory is everything. A growing company might be losing money today, but the expectation is that it'll earn $1 tomorrow. A value trap? It's earning $1 today, but everybody can see it's on a one-way street toward earning nothing.
And this brings us full circle, right back to that super tempting 10% dividend. When you look at it through this new lens, that high payout isn't a sign of a strong, healthy company. It's a signal of something else entirely. It's the last gasp. It means the company's management has looked around at their business and they can't find a single good project to reinvest their cash in to create future growth. So the only thing left to do is to just give it all back to the shareholders before the business disappears for good.
So, if trillions of dollars are being structurally forced out of these old energy sectors, that money has to go somewhere, right? It doesn't just vanish. The other side of this coin is the new energy calculus, figuring out exactly where all that capital is flowing to.
The biggest story in the world right now is the AI revolution. And what does AI run on? Power. A truly massive, crushing amount of power. The demand is so intense that tech giants are basically having to become power companies themselves. I mean, Microsoft is seriously looking into building its own nuclear power plants just to feed its AI ambitions. This is creating a hunger for energy that the world has just never seen before.
And here's the sense of the scale of that demand. Worldwide spending on AI is projected to hit more than $2.5 trillion by 2026. Every server, every data center, every single algorithm behind that number needs a massive and growing amount of electricity just to exist.
And this is where that positive screening side of ESG really kicks into gear. The capital being pulled out of coal isn't just sitting in cash. It's being redeployed to build the new energy grid. We're talking about the picks and shovels, the companies that handle the cooling for these giant data centers, the ones building advanced networking gear, even broad ETFs that just invest in all the power infrastructure. And of course, a huge chunk is flowing into sustainable energy, like wind and solar.
So here's what it all boils down to. The crucial point for investing today isn't just about finding what looks cheap on a spreadsheet. It's about understanding these massive tectonic shifts in capital. It's about seeing which industries are facing a structural headwind, a shrinking buyer base, and a broken valuation model, and which ones have a structural tailwind, with trillions of dollars flowing their way. It's really about figuring out where the future is being built.
And so we end right where we started. That high dividend from a company in a dying industry, it feels safe. It's cash in your pocket today. But investing is always about the future. It's about eventually selling your asset to somebody else. And the most important question you have to ask yourself is this: with trillions of dollars legally forbidden from ever touching this asset, who exactly is going to be left to buy it from you tomorrow?